Hey everyone, Logan Hertz with Hazeltine LLC. We are on part 4 of responding to the wealthy accountant's critique of infinite banking. I have with me, as always, Peter Nelson. Peter, how you doing?
Doing good, living the dream, living the dream.
Okay, so in the last part of his article, he's going to show us some alternatives to infinite banking, which he claims actually work. They actually deliver on the promise of infinite banking. And of course, we've seen before about how his critiques are what most critiques are, namely based on fundamental misconceptions of what infinite banking is and how whole life insurance works. Now, before we get into his infinite banking alternatives, I just want to reiterate some of the promises that he's made throughout this article about his alternative, right? Um, Here we go. So I will share a strategy that actually delivers on the promise of infinite banking without the need of a bank or insurance company. Okay, so there's no bank or insurance company involved. There are no products to buy, so you don't have to buy anything. And I will sell you nothing. So he's not trying to sell you anything. You keep all the money. Got
Mother
that?
Teresa.
Let's see how many of these promises he can actually deliver on. Okay, so there's no bank or insurance company involved. There, you don't have to buy anything, no products to buy. He's not going to sell you anything. You keep all the money. Sounds pretty good to me, right? I mean, wow. Okay. That sounds even better than the promise of infinite banking. Okay, so let's go down and see what he's going to talk about. All right.
Is
Infinite
he
banking alternatives.
does he also work for the US Department of Treasury? Does he print the money or just
All
checking?
right.
Dad
Yeah,
joke.
just check it. Just check it. Just check it. Okay. So the first infinite banking alternative is only available to certain people. People with debt or a mortgage works best. This in no way means you need to go into debt so you can use this strategy. The next strategy is a variation of this strategy where no debt is necessary. The only reason why I start with this strategy is because it can generate a larger return for some people, and it also helps you get out of debt faster. Here is how this strategy works. You'll need a mortgage and line of credit. You move a portion of your regular mortgage to the line of credit. Your regular mortgage is now paid down a bit more than it would have been. Instead of keeping more than a token amount in your checking account to pay bills, you will drop the money into the line of credit. You now pay no interest since that amount is no longer borrowed. When you need money to pay bills, you can transfer money from the line of credit back to your checking account. Your rate of return on your everyday float is the rate of interest on the mortgage. Now, let me stop there. This is a ham fisted way of trying to explain velocity banking, which is a strategy that I believe in. So I want to give him credit that this is a good strategy. It doesn't quite work how he's explaining it, but it's a good strategy, which I believe in. It's certainly not a replacement for infinite banking, but it is complementary to infinite banking. Okay. And it shows that he actually understands some of the ways in which infinite banking works. Okay. So what you're doing is you're running your cash flow through a home equity line of credit and using that to pay bills. Okay, so you're running your income into an appreciating asset, your home, and you're paying down debt, your mortgage as you do it. Okay. But we can actually take his strategy to its logical conclusion. Don't take out a line of credit on top of your mortgage. Replace your mortgage with a first lien HELOC, a first lien home equity line of credit, and practice velocity banking using that first lien HELOC. This is a strategy that I believe in. It's called velocity banking, and it's great. So this is a good idea. We agree on this. We agree on this strategy. But you can do both, right? In fact, I think everyone should be doing both. Everyone should be doing both velocity banking with a first lien HELOC on your primary residence and infinite banking using specially designed whole life insurance policies.
So
Um,
I'm kind of stunned because from my experience, velocity banking and IBC go hand in hand very, very nicely. So he wants to bash IBC, but yet he wants to push velocity banking, or is he serious?
yeah, yeah. Now, let me explain why velocity banking does not deliver on the promise of infinite banking, why it is different. You just have to ask one question. Who has control? Who has control? Remember, infinite banking is not about arbitrage. It's not about rates of return. It's about control. You want to reclaim control of the banking function. When you take out a policy loan from the insurance company, you control the borrowing terms. You decide if, when, and how you want to pay back that loan, right? You have control. Okay. You have contractually guaranteed rights. Okay. With velocity banking, it's similar, it's analogous. The problem is who has control? Who dictates the terms of borrowing? Not you, the bank, right?
Wait,
Whatever.
I thought this option had no banks involved.
Right. Yeah. We'll come back to that. Right. Yeah, but there's two points I want to make before we get to how
Okay.
many of his
Sorry.
promises did he actually keep.
I just
Right.
couldn't
So
help myself. I'm like,
I
what?
know. Yeah. So the first one is, who has control. So again, I think velocity banking is a great thing to do, but it's not a replacement for infinite banking because you're still having to go to a bank, and the bank is going to dictate the terms of that home equity line of credit. You've got to qualify. They'll tell you what the interest rate will be, what the terms of borrowing will be, and there will be a repayment schedule that you must adhere to, or there will be consequences, right? The other big difference is that your house is not guaranteed to go up in value, right? It could collapse in value. Things could happen, right? Whereas when you're borrowing against whole life, your whole life insurance policy is contractually guaranteed to go up every single year. Your cash value, contractually guaranteed, must go up. It cannot go down. So that we have guarantees, which is part of the reason why the policy loan is such a favorable credit instrument. There are other differences between the two as well. But that's why, while velocity banking is great, it's not a replacement for infinite banking, right? You don't have control over the borrowing terms, and the asset you're borrowing against is not guaranteed, right? And let me just finish this out a little bit, because now he also shows his ignorance of another concept. So he says, caution. If your line of credit has a higher interest rate than your mortgage, this strategy runs into problems. No, that's false. He doesn't understand the difference between simple interest and amortized interest.
Right.
Okay. It's not about interest rates. Okay. So this strategy works, and I'll show you how it can work even if the interest rate on the line of credit is significantly higher than on the mortgage, right? Because the HELOC charges simple interest, whereas the mortgage charges amortized interest, right? So it's more about cash flow efficiency. So again, he's getting lost. This is what these numbers people do sometimes, is they get lost in numbers, not understanding what those numbers mean, right? So he just says, well, this number is bigger than that one. Not understanding, yeah, but the bigger number is a simple interest rate, whereas the smaller number is amortized interest. So that's not an apples to apples comparison.
Simple interest for the first 10 years, right?
Well, throughout all of it. Well, okay, so you're talking about the draw period. Yeah.
Okay.
And it depends which one you're using. Some of them have it for 30 years. It just depends, right? There are different strategies.
Yeah, I just
It is true, though, that there's no such thing as simple interest for an infinite time frame. That's true.
that's all I was. Yeah.
Yeah. When interest rates were very low for a decade, this strategy worked better. If your mortgage has a higher rate, you can still use this strategy as long as the line of credit interest rate is similar or lower than your mortgage interest rate. Okay, so, but yes, now let's return to your point, Peter. How many of his promises did he actually keep? Okay, so he's talking about using a line of credit, etc. Okay. So he's saying
Yeah, right
that
there.
delivers on the promise of infinite banking without the need of a bank or insurance company. How are you going to take out a line of credit without a bank, Peter? Not only do you have to go to a bank, you need the bank's permission. They can decline you, right? If you don't have a good credit score, they might say no, or they might give you a much higher interest rate, right?
Yeah, I call BS right there.
Without the need of a bank or insurance company. Peter, if you take out a home equity line of credit against your house, will the bank allow your home to be uninsured?
Nope.
So we need a bank and an insurance company. We have to have homeowners insurance,
That's a
right?
good point. Yeah.
So no, you need a bank and an insurance company. There are no products to buy. Peter, I think a home equity line of credit is a product that the bank sells.
Yeah, I'm pretty sure that's a product.
I'm pretty sure there are closing costs associated with that. You got to pay for an appraisal, fees, etc. So there actually is a product that you're buying. A line of credit is a product that the bank provides. So you are buying a product. Okay. and he's selling me nothing. Well, you're selling me a home equity line of credit.
And he might not be technically,
Yeah, whether he benefits from it or not, he's still selling me something, right? He's certainly benefiting indirectly, right? The whole purpose of this article is to drive traffic to his website in order to sell his products and services. Period.
and
This
that's
whole
okay, right?
that yeah, there's nothing wrong with that, right? He's putting out content in order to build up his public profile, build his brand, and attract business, and that's totally fine. Just don't pretend like you're not selling something. You are, right? Look right here.
Yeah.
Look, I can sign up for his I can sign up for his email list. I can, click here. He's got all his other stuff. Look, tax prep, tax pro near me. We recommend blah, 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 right? Like it's all here. The whole point of this website is to sell his products and services. By definition, you are trying to sell me something.
But instead he's trashing, he like I said, he's pulling the Dave Ramsey, Ken Fisher deal. Instead of actually providing value and making up own content, he's just going to pick, I'm going to go trash cash value life insurance and IBC and insurance companies. And that's the way I'm going to make a reputation, which I'm sorry. That's like really low class.
Yeah, and it's interesting. He's always picking on the little guy. I wonder if he's has articles that attack the Federal Reserve, JP Morgan Chase and the banking system, Wall Street, the IRS.
Yeah.
Like, why don't you go after the big boys, right? Instead of going after the little guy, kind of like the what a bully would do, go look for weak people and pick on them. Why don't you go after the big boys who, even if what you're saying about these scummy life insurance agents is true, okay, who's doing more damage to the American consumer? Your little life insurance agent who maybe, tricks a few people into buying large whole life policies, or the Federal Reserve, right?
Right.
I mean, come on, they're literally printing the money.
Yeah.
But no, he's just going to go after the little guy, because if he goes after the big boys, they can actually fight back, right? But the little guy can't fight back, right?
By the way, Logan, it reminds me, talking about the little guy, I delivered I think it was, I forget if it was 50 or 100,000, but even let's just say it was 50,000. This deacon had passed away. He died. His wife found him out in the yard, just died next to his tractor, right? I walked in with that $50,000 check. I wrote that policy 2 years earlier. I think they paid the insurance company like $8,000. I gave him a $50,000 tax-free check, but yet we're ripping off the little guys, right?
Mm-hmm. Mm-hmm.
Doesn't sound like a bad deal to me, does it? Now, someone had
Yeah.
to die, and that wasn't a good thing, but she was actually able to pay off the remainder. Since we're talking about mortgages, she used a portion of that money. She paid off her mortgage and used the rest to help live off of, because now her income went down, and it wasn't enough, frankly. But still, I mean, like, this is what we do as life insurance agents. We walk in when everyone else has their hand out wanting money. We walk in with a check saying it's gonna be okay. I've done that so many times. Literally those words, it's gonna be okay. That's what we do.
Right. We protect widows and orphans as opposed to what some others more powerful than us do, which is taking advantage of widows and orphans, right?
And it's even
Um,
biblical, right? It's biblical.
yeah. So that widow, do you think her retirement balance automatically went up by hundreds of thousands of dollars or millions just because her husband died?
No, her Social Security, she lost a Social Security check, and she's probably going to bump up into a higher tax bracket the following year because now she's going to be single instead of married filing jointly.
Mm-hmm. Did her mortgage magically get paid off just because her husband died?
No, it got magically paid off when I walked in and handed her the check, but yeah.
Did her other debts get magically paid off when her husband died?
Nope.
We have a leveraged death benefit, right? So when the insured dies, that death benefit pays out tax free, right? It's a self completing plan. There's no other asset that can do that for you. Okay. There's no other asset that can do that for you.
And it
All
doesn't
right.
take long, ladies and gentlemen, to get that money. You have, once we get a death certificate, not that this was about paying claims or anything, but once you get a death certificate, we file that paperwork. We're going to have that check to you lickety split. Typically, it comes right to the agent, and we're going to be right there to deliver that money for you. If you're out of state, we can have it sent directly to you, but that's what we do. I'm almost feel like I know this is a little corny, but like I'm on a crusade I want to pay as many claims as possible. I don't want people to die, but none of us are immortal, right? That's what we do. We pay claims. We're there. Just people think that it's all about us selling policies. No, my goal in life is not to sell millions of dollars of face amount. My goal is to actually deliver millions and millions and millions of dollars of claim checks. That's my goal. And that's all of our goals. I know your goal too. So,
Right. And with whole life insurance, it doesn't have to be a tragedy, right? With term, it does, right? If someone dies with a term policy in force, it means they're probably not 95 years old, right? You can't get term at 95 years old. So something tragic happened, which I'm glad they had that policy. Don't get
well,
me wrong.
look at
But
the
with whole life,
situation I talk about. Well, how old was the guy that I delivered the $1.2 million check? 35, I think. The only one I've written in 22 years in this business that ever paid out for term. But I've delivered a lot of whole life claim checks. Okay. You know what the funny thing about whole life is? You pay the premium. I can guarantee that you will use that money while you're alive, or your family, business, or charity will get it in a, tax-free death benefit when you die, right? I guarantee it, right? We can guarantee that with whole life. That's what makes whole life so darn special. You pay the premium, we will deliver that claim.
the guaranteed result. It's a guaranteed result. So yeah, and the claims process is very easy, right? It's like, hey, you're either dead or you're not. It's very simple. We don't have to like fight over who was responsible for that car accident and is this damage actually, your fault, or is that contractor, charging a fair price? No, it's very simple, right?
Except if it's within 2 years, then they can they want to see what's going on with the death and all of that. And I've actually had death claims within 2 years. I've never had a death claim declined.
No, and I know people who's got a lot more experience than you, and they've never seen it either. They've never even seen one investigated. Um, it's extremely rare. You're talking about the period of incontestability. So when you take out a whole life policy, there's a 2-year period within which it could be contestable if you had lied on your application, as an example, right? After it's been 2 years, even if you lied on your application, they will pay that death claim. It's no longer contestable, right?
Yeah, and they're
And
more
very,
looking.
very, very few people die within 2 years of taking out a policy, right? That's of course incredibly rare.
What's that?
It's very rare that someone dies within 2 years of taking out their policy. But no
No,
one I know in the business has ever seen a claim be denied.
right. No, I agree. But I think I've delivered 3 that have died within 2 years,
Okay.
whole life. By the way, I think 1 or 2 of those were 10 pays. So of course I didn't know any better, and they wanted the 10 pay option. They were not young either, by the way. They were in their, I believe, 60s. Okay. But I would have, if I would have had to do it again on those policies, whole life at 100. But you don't know, right? You don't know. But I'm saying this more for the agent out there, and I really like the 10 pay, by the way. Okay, what's a 10 pay? It's you pay for 10 years and it's paid up, fully paid up, right? But I am now to the belief, and I know Logan, you're big about whole life at 100. Um, and I still do 10 pays and 20 pays, but the whole life at 100 makes a lot of sense a lot of times. So
It is a privilege, not a right, a privilege to pay a premium into a whole life policy. And whole life policies get more efficient every single year they're in force. So you want to pay the highest possible premium for the longest possible time frame. We have to stop seeing the premium payment as a liability. It's not a liability. It is one of the most amazing financial moves you can make is to pay a premium into a whole life policy. You want to secure that right for as long as possible. So yeah, that death benefit would have been a lot higher if it had been a pay to 100 or whatever the maximum time frame
yeah,
that the insurance company will let you pay, because they don't all let you pay to age 100.
right. And those couple claims, they weren't big claims, but they were people that didn't have a pile of money. So an extra 10 or 20 or $30,000 actually goes a long way, especially here in the hills of East Tennessee, you know? So anyways,
Okay. And then, of course, his last claim is that you're getting a free lunch. So after all that, he says, you keep all the money. Well, if you take out a line of credit, doesn't it charge interest? And I don't think you keep that money. I think the interest goes to the bank, right? So no, there's no free lunch. You're not keeping all the money. You're paying for the closing costs. You're paying interest to the bank, right? There's no free lunch. And get this, Peter, you ready for this one? When you take out that home equity line of credit, whoever sold it to you makes a commission. Wow. Wow. Because of course it all boils down to it's evil for you to make money, but it's fine when I make money, right? So whatever method you make money with is somehow evil because you're getting it via commission. So we know that's evil. But if I'm collecting money, like say it's some sinecure, some do nothing job, let's say I work for the government where I'm just collecting the paychecks, that's totally fine, right? But if you have to actually work and earn that money via commission, that's evil. We can't have that, can we? Can't have that.
by the way, is this just curious? Not that it really matters, but is this guy a fiduciary?
All right. So
Sorry,
that's the
couldn't help.
first infinite banking alternative, which is not a replacement for infinite banking, but which is a good strategy, velocity banking. Again, his explanation of it is not very cogent. Okay. And then this is just more a visual, more confusing explanation of it. I have other videos on velocity banking if you want to check them out. It's a great strategy. It's a great strategy.
Oh yeah,
So,
there's no
so I'll
doubt.
give him credit for that. It's a good strategy. Okay. The second infinite banking alternative anyone can use. Infinite banking, as promoted by insurance agents, is designed as a big savings account you can borrow from. No, borrow against, not borrow from. Your original money keeps earning even when borrowed out to you, while the borrowed funds are invested in other income producing assets, the so called double dip. As we saw above, the insurance company is not the warm, fuzzy entity handing out free money. Okay, so once again, he's got to make ridiculous caricatures, right? Who said that the insurance company is a warm, fuzzy entity handing out free money? Right? This is just a ridiculous caricature. Okay. Obviously, nothing's free. Okay. Nothing's free. Your
By the
money
way,
is still growing
is
because
Walmart
you,
handing out free stuff all the time?
well, this guy is apparently.
I mean, it's like the insurance company is something super evil, whereas like Walmart or Tractor Supply or anybody else
Mhm.
offering services and products, like, yeah, anyways.
Yeah. His philosophy is fundamentally Marxist, whether he realizes it or not, which is that every economic relationship is fundamentally exploitative. When I go into business and offer you a product and you pay me and I profit from you, I've exploited you. Or when I hire you as an employee and I pay you a salary, I've exploited you, right? That's basically where this, if you take his argument to his logical conclusion, right? I mean, that's what he's saying, that when you profit from somebody else, you have exploited them, right? You should be offering that stuff for free. Then it wouldn't be exploiting you, right? Okay. If you eliminate the insurance company and invest the same monies, you will have more because you don't have middlemen to pay. No, there are always middlemen. Okay. When you invest it, guess what? You get charged fees. They're your financial advisor or whoever's helping you invest it, right? I mean, there are always fees. If you invest in real estate, there's a realtor who makes money. There's a bank who makes money, right? If you put your money into mutual funds, well, the mutual funds themselves are charging fees. Your financial advisor is charging fees, right? There's no free lunch. There's no free lunch. Okay. So no, there will always be middlemen to pay. Okay. You can't invest by yourself. What are you going to invest in by yourself? There's always fees. Okay. If you're investing the money yourself, there's still a broker. I mean, there's always a cost. Okay. There's no free lunch. And the interest rate paid is probably higher depending on current interest rates. Okay. Once again, it's not about interest rates, but the interest rates on policy loans are very, very competitive, especially when you consider it's simple interest, not amortized for compound interest. But I'm sure he throws this out there. He doesn't quantify it. He has no idea what policy loan interest rates are. And he's already demonstrated he doesn't understand the difference between simple versus amortized versus compound interest, right? So, okay. With this in mind, Treasury Direct is an excellent tool for building wealth with your excess funds earmarked for savings and no state income taxes. By purchasing short term T bills directly from the US Treasury, your money is always liquid. You can withdraw your money at any time. You can always call it borrowing your own money if you want. So, once again, he's acting like these are the same thing. When you withdraw your money from an asset that's growing, like, say, Treasury bills, you're no longer earning on that same principal balance. Whereas when you take out a policy loan against your whole life policy, your money in the policy keeps earning. So, no, it's completely different. Anytime you withdraw, you interrupt the compound interest you're earning. With whole life, we are not interrupting the compound interest we're earning in the policy. So, no, it's not at all the same thing.
By the way, is he giving investment advice?
Yeah, it's a good question. It's a good question. It sounds like investment advice to me, right?
By purchasing short-term T-bills directly from the U.S. Treasury, your money is always liquid,
Yeah, that was one I questioned too.
and he can guarantee that.
Yeah, that was my question. What do you mean? It's always liquid?
So if I buy a 3-month Treasury, you can guarantee me, wealthy accountant, you can guarantee me that the next day I can get all my principal back. You can guarantee me that.
Right. A treasury bill is by definition illiquid. I'm glad you brought that up. At least for a period of time, right? You're loaning the government money and they're going to pay you back according to the schedule. You can't get your money back the very next day. So you're right. This is factually incorrect. It's not always liquid.
Yeah, that's really dumb.
If you want your money to be liquid, don't loan it out to somebody else. That's a bad idea. If you want your money to be liquid.
I really hope this guy is not a fiduciary.
I don't think he is. I don't think so. No, this wouldn't get past compliance. I'm not a huge fan of compliance departments, but I'm pretty sure they'd catch that one. I'm pretty sure they'd catch that one. Like, no, no, no. Okay. The same concept works with money markets accounts, grammatically incorrect there, at financial institutions, banks, or credit unions. Wait, Peter, I thought he said there was no bank involved.
Maybe
But
that
now
was
he's
it for-
but now
was
he's
that-
telling you to go and buy a product at a bank.
Was that for just option one, or was it for both option 1 and 2?
This is option 2.
But I mean, did he notate up top, he said that there'd be no insurance companies?
I don't know if he's
involved?
specified. He's not that specific. Come on, man. He's not that precise. I will share a strategy that delivers on the promise of infinite banking without the need of a bank or insurance company. He says a strategy. He doesn't specify which one he's talking to, but both of them require a bank, right? These all require banks.
Yeah, he's totally doesn't even. Yeah.
So no, it's not the same concept at all, because again, as soon as you withdraw your money, it's no longer earning for you. Whereas when we use our money through our infinite banking system, it keeps earning for us. So no, it's not at all the same thing. Okay. Here is the magic of infinite banking. When you borrow your own money, you also pay yourself an interest rate. That is how the insurance company gets you to believe you are magically growing your wealth, even while money is out on call, borrowed. Well, no, there's no magic to it. Your money keeps earning because you didn't withdraw anything. You just borrowed against it using a policy loan. So that's exactly how it works, right?
Can I just show you the flyer that the insurance company literally has that on the, they say that your money continues to grow even when you have a policy loan.
Yep. And when he says here, I don't know what he's talking about. Here, where? I don't see it. In a nutshell, this is the thinking fund. It's funny how many non sequiturs he has in this article. In a nutshell, this is the thinking fund. What? No, I don't see that at all, right? Or here's the magic of infinite banking. Again, total non sequitur. You pay interest as if it were a loan when you pull money from the fund. The infinite banking people want you to think this is only available from them, but it is such a simple concept. Think Occam's razor. Anyone can do it, and insurance has nothing to do with it, structured or not. Well, it is true that insurance has nothing to do with it. We're talking about basic financial concepts, banking, right? Understanding how banking works. So yeah, that's true. Insurance doesn't necessarily have anything to do with it. It's just that whole life insurance happens to be the ideal vehicle for it, but it's not the only one. And the concept per se doesn't have anything to do with insurance. That's true. And it is a simple concept, but that doesn't mean it's easy to understand because it's so counter to what we've been taught, right? Just because it's simple doesn't mean it's easy to do or easy to understand. right? All great financial strategies are indeed simple. Okay. If you ask big time real estate investors what their strategy is, their strategy at a high level is going to be relatively simple. Okay. But if it were easy, everybody'd be doing it. Okay. The infinite banking people want you to think this is only available from them. Well, no, I mean, you could do it in other ways. Like, I mean, it's certainly not only available from me, right? Um, I think there are unique features to specially designed whole life insurance that make it far more advantageous than anything else. But again, he's just contradicting himself. Okay. What if I need life insurance? Some people looking at infinite banking realize they have a temporary need for life insurance. A temporary need for life insurance. This is totally just he's begging the question, right? Is your need for death benefit temporary?
This is a buy term and invest the difference.
Right. He's already begging the question, right? No, it's not temporary. Right? Is your need for housing temporary, Peter?
No.
No. Now you can rent a house. You can do that. But your need for housing doesn't go away whether you buy a house or rent a house. Same thing with life insurance. You can rent life insurance by buying term, or you can actually own it by buying permanent life insurance, right? The question is not what do you need, because nobody needs life insurance. Nobody needs mutual funds. Nobody needs a line of credit. Nobody needs any of this stuff, okay? The question is, what would you want, right? When you're 95 years old, do you want a $3 million death benefit to be paid out? Why not? Do you want a $3 million legacy? Do you want $3 million of death benefit when you're 35, 45, 85? Yes, of course. Of course, especially when that 3 million is liquid, you can use it, you can spend it, you can use it in the event of long-term care. It's all tax-free, it's creditor protected, you can borrow against it. Go on down the list. Guaranteed to grow, right? Okay, so no. Term life is the perfect solution to a temporary need. Well, yeah, if you're going to be dishonest and couch it as a temporary need, then term life insurance is the perfect solution. But you set up the question in a dishonest way, right? For protecting against the loss of a breadwinner. I thought he said he wasn't going to sell us anything, Peter. This sounds to me like a sales pitch for term life. Tell me how this is not trying to sell you something. Term life is the perfect solution to a temporary need for protecting against the loss of a breadwinner. I thought he said he wasn't selling us anything. Okay.
Term life is a temporary solution to a permanent problem.
Yes, exactly. There are far fewer reasons for permanent life insurance. Key man insurance and as part of a buy-sell agreement come to mind as a possible good reason to purchase a permanent life insurance policy. It's interesting because Chris Kirkpatrick went into this, not on our video, but in a different video, where he talks about how actually, for these, actually, term is actually a good solution.
Listen, a lot of the ones I've done have been term.
Yeah. So
like,
it's actually the opposite. I mean, you can, and it might make sense, but actually, term can work in those scenarios. So it's kind of funny.
Absolutely.
And of course, he's not making distinctions. There's a big difference between, say, convertible term and just straight up term, right? We got to make distinctions. There's a big difference between those two. I love convertible term. If convertible term with a company that has a competitive whole life product is one of the best things you can buy. It gives you so many options. It's a great solution.
How about convertible term with living benefits even?
Exactly. See, that's another distinction. He's probably not aware of this, right? So again, you can't just say 3 million in life insurance equals 3 million in life insurance. No. Straight up term is different from convertible term, with living benefits. And you got to consider what's it convertible to, right? If it's a convertible term policy with a company that doesn't have a very good permanent product, it's not all that great, right?
Like Banner. Oh, you can convert Banner. You get typically one UL contract to convert it to, and that's not even good, right? But everybody, oh, let's buy the cheapest term out there.
Do you think he knows the difference between universal life and whole life? Probably. He never mentions universal life. So I'll give him credit that he doesn't confuse the two in the article. But, you know, when he says permanent life insurance, he probably doesn't realize, well, there's whole life, there's guaranteed universal life, there's index universal life, there's variable universal life, there's universal life. And of course, all of those can be designed in almost infinite number of different ways, right? So it's kind of hard to make a blanket statement about all of those, right? In conclusion, there are no good reasons to engage infinite banking. It is a fancy term coined to sell high-priced life insurance with ample commissions to the agents and massive profits to the insurance companies. Here we go again with the Marxist rhetoric, right? It's all win-lose. It's all exploitative. When you take out a whole life policy from an insurance carrier, the agent exploited you. The insurance company exploited you because they're just greedy, evil, money-grubbing capitalists, right? But when he makes money selling term, oh, that's perfectly fine. No problem there. So here we go again.
High priced.
High priced. Well, you know what high priced means, Peter? High value. High value. If you buy a dirt cheap product, it's going to be dirt cheap quality, right? To quote this guy, there is no free lunch. If you want a high quality product, it's going to cost you a high amount. Now, notice also how he doesn't quantify it. I was like, oh, you say it's high price? Please quantify that. I can show you how term is way more expensive than whole life over the long run. And it's not even close. It's not even close. Way more expensive. Okay. If you buy term, you are buying the most expensive form of life insurance out there. When you buy whole life, you are buying the most cost-effective form of life insurance out there.
And by the way,
I can show this to you.
And by the way, the most profitable type of life insurance is term life insurance, when less than 2% of all term policies will ever pay out. And by the way, I'm not bashing term, okay?
Right.
We both write a pile of it.
Mm-hmm.
But there's a place for term. There's a place for cash value life insurance. But just bashing one, making the other one look like it's the Swiss Army knife. What a
Right. As you say, it's not term versus whole life. These two are not in competition, right?
Oh my
they're
gosh,
both great. They're both great, and they serve great.
Right.
So usually with my clients, we end up with a blend of convertible term and whole life, and the two work together, and it's a beautiful solution, right?
Right.
We don't engage in these overly simplistic caricatures like this guy does.
This is our definition, what we talk about all the time, of financial malpractice right here. This section here is financial malpractice.
Setting up a false dichotomy. It's either that evil, high-priced, expensive whole life or that wonderful, cheap term, right? So, yeah. Okay. With ample commissions. Ooh, see, you made money. That makes you evil. Ample commissions. That's just not. You're greedy. Well, you know how you make a lot of money? Add a lot of value, right? It's clear to me that this guy, I don't know, he seems to have no real experience with life. He seems to think it's like ridiculously easy to make money as a life insurance agent. If it really were, if whole life were really this unbelievably lucrative product where the agents were making a ton of money, everybody and their brother would be trying to become a life insurance agent. The same way that everybody and their brother was buying real estate during the bubble, like between 2006 and 2008, like everybody was piling into real estate because there was so much money to be made, or so they thought. If this were really true, if Peter and I and people like us were really just sitting back, greedily, rubbing our gold coins together while we exploit our hapless, naive little customers, everybody would be trying to do it, right?
Yeah.
And he seems to think that our customers are so naive and so foolish that they could just be taken in by some slick marketing and sales tactics.
When 75%,
right? People are not dumb. Okay, people are not dumb.
When 75% of all life insurance agents fail within 3 years of being in this business.
92%. The number is 92%. 92%.
Oh, okay. It went up. It used to be 75. So, okay.
Yeah, 92% fail. Okay. But I don't think that it's wrong for someone to make money. This guy does. If you make a lot of money, that indicates you are adding a lot of value. Did Steve Jobs like exploit those hapless, naive little Apple customers and just take advantage of them and take them to the cleaners? It's like, no, he provided innovative products that they wanted at prices they were willing to pay. He improved their lives. Otherwise, they wouldn't give them their money.
By the way, if you had a tumor, okay, in your chest, and that doctor goes in, that surgeon goes in, removes that, are you going to be upset that he was charged a ridiculous amount of money to do that? No, he has a skill. He did it, right? You just want the tumor out of your chest.
Right. And why would that surgeon go into massive amounts of student loan debt and spend years in school to learning to be a surgeon if there wasn't the hope of making a really high amount of money, right?
Right.
The profit motive helps. Otherwise, if he couldn't make money doing it, why would he rack up six figures worth of debt and waste years of his life
And the
when there was
stress
no hope?
and the stress.
Right, when there's no hope of profiting from it. The reason why he does it is because he can make a high six-figure, maybe even a seven-figure salary, so then he can pay off those student loan debts and actually get ahead, right? The profit motive means now he's willing to do something that he would not have been willing to do otherwise, right? So
Yep.
no, we're not Marxists here. It's not evil to make money.
It's stunning to me.
Yeah, but it's not a zero-sum game. Wealth is not a zero.
Well,
Massive profits to the insurance companies, Peter. Peter, if you take out a whole life policy from a mutual insurance company, who gets to share in the profits?
policyholders.
Exactly. So if the mutual company has massive profits, that means you get a bigger dividend. That's a good thing. That's a good thing. So why would you want to work with an unprofitable company? If you take out a life insurance policy from an unprofitable company and that company goes bankrupt and then you die, where does that leave you? Who's going to pay out that death benefit claim now that that company is bankrupt? It's what he's not saying. The implication of what he's saying is when you do business with a financial institution, you want to try and fleece that financial institution. You want to take them for all they're worth, be a parasite, take as much money out of them as you possibly can, and leave them nothing because wealth is a zero-sum game, right?
Yeah, and by the way, does this guy realize that traditional whole life companies are going away, that there's not nearly as many as there used to be? Now, you know, and I know that if whole life was so profitable, everybody would be offering it, right?
Mm-hmm.
That's just not the case.
Right.
What are they,
If what
what are they going to? Term, lots of term, IUL,
Mhm.
that kind of stuff, right? Whole life, non-participating whole life, but there's not more companies shooting up left and right that are offering traditional cash value whole life with dividends. It's not.
Well, part of the reason is because in order to do that, you really have to, in order to support that business model, you have to be a well-established company, right? It takes a lot of capital and a lot of time. So it would be very difficult for a startup to do that. They just wouldn't have the capital, they wouldn't have the time, et cetera, to do it. Which is why the companies we're working with have paid dividends every single year straight for over 100 years, right? They are bellwether companies that are very, very, very stable. But I reject the premise that it's evil for a company to make profits. If I see that a company is profitable, that's a good thing. That makes me more likely to want to do business with that company, not less likely, right?
Yeah, it's
So
like,
I reject the whole premise. Profitability is a good thing. That's a good thing.
all right. Last time I checked, plenty of people are Apple's fairly profitable, aren't they?
Yeah. Yeah. Okay. You can reach the same outcome as infinite banking with better results, more liquidity, no risk of a policy lapse triggering a massive tax problem, and more options if you use my alternatives. I think we've shown how that's not true at all. Okay. I get no commission for selling you a product. So here we go again. It's evil to collect a commission for selling you a product, right? This is Marxist,
Right.
straight, pure and simple. My bias is good information. So come back here and read more articles. Wait a minute. You say my bias is good information, but now you give me a sales pitch. Come back here and read more articles. Right?
My bias is good information.
Yep. So on that same page where he says he's only here to give you good information, he's got a banner ad. See, he's got a banner ad. He's got an email list you can sign up for. He's got other things you can click on where you can buy his services, right? So it's again, the words coming out of my mouth are the opposite of what my actions are doing, right? That's why I have to virtue signal and loudly announce that I have no bias and loudly announce that I'm just doing this out of the goodness of my heart
Right.
because of course I am trying to sell you something.
Because he is, Logan, he is literally so wealthy that he just gives all this information out because he's Mother Teresa.
Right. Right. Yeah. So, I'm trying to make money. Sure. I run a business. I don't apologize for that. I don't pretend like it's evil to make profits. Right. I'm proud of the fact that I've made a lot of money adding a lot of value to my clients. right? If you want someone to, say, give you financial advice or help you optimize your financial situation or develop a good financial strategy, do you want to work with someone who is good at making money or someone who's not good at making money, right?
Right.
It's a virtuous cycle, okay? It's not a
Yeah.
zero-sum game. Compare that to the biases the promoters of infinity banking receive. Well, that's not proper grammar. The biases that the promoters of infinity banking receive, bad grammar. And then infinity banking, no, that's not a thing. Infinite banking. Here's the video from the promoter used in this article. So here again is the 5 mistakes people make with infinite banking, the Chris Kirkpatrick video, right? Look, we all have biases, period. I love the infinite banking concept, okay? But I don't claim to be objective. This guy does. Well, he's not. We all have biases, right?
Sure.
When people say they're unbiased, what they're saying is my biases are so strong and buried so deep that I can't even see them, right?
I've
The
got
most
my,
biased people in the world are the ones who think they're being objective and unbiased. Whereas the rest of us who are being honest will admit our biases up front. Yes, I am biased in favor of the infinite banking concept. There's no question about that. I'm a true believer. I don't apologize for that. I don't pretend to be unbiased either. I don't pretend like I'm not trying to sell you something, right?
yeah.
So that was the end of the article.
Yeah.
Quite entertaining.
Yeah, it was fun.
So, Peter, anything you want to say in closing?
Um, yeah, I think after we, the 4-part series, I hope everyone realizes that once again, we would have to give this one the stamp of approval of financial malpractice. I'm sorry, it's just, it's bad. There was multiple things. You get it through the 4-part series, you'll see why, and these things, as me and Logan do this series over and over again, you notice it's all pretty much the same things, right? That we're running into.
Yep,
It,
yep. Recycling the same fallacies.
and that's what bothers me the most, Logan. It really does. It's we are going through in this country so many bad things right now, and the last thing we need is for the American public. I see it all the time. People don't take action because they're so confused at times, right? They see this, they see that, and it's social media. I think even though we're both on it, it's like they're like deer in headlights in a way, and yeah, it's not good.
Well, yeah, it's Soviet style propaganda in that you keep repeating something over and over and over again, and people start to believe it, even if it's demonstrably false, right? So they keep repeating the same talking points. They're repeating Wall Street talking points, whether they realize it or not, based on fundamental misconceptions. And since this guy engages in a lot of self-righteous moralizing, I'll do a little bit of moralizing. Like, how many widows and orphans do you think people like this ruin, right? Because they are contemptuous of whole life insurance, which has protected so many families, taken care of so many widows and orphans, rescued them from the disaster of, having something happen to a breadwinner, right? They act like term and whole life are the same thing if they have the same death benefit. Not at all the case. Not at all the case, right? I mean, term life insurance is like having an umbrella. That's not going to protect you from a hurricane. It'll protect you from a shower, but it's not going to protect you from a hurricane. You need an actual house, an actual permanent structure that has stood the test of time that will protect you from now for the rest of your life, right? That's what whole life does for you.
Yeah, whether you're alive or whether you're dead, right? That's
And it
what going.
protects your insurability. People act like they can get life insurance anytime they want. No, you cannot. You cannot. Age comes into it, health comes into it, right? Finances come into it, right? So no, you need to secure that on a guaranteed basis while you still can.
Yeah. Look,
It's
I'm super preferred. Okay. Every policy I have says super preferred all across it, right? But I know there's going to be some point, probably in the near future, where I'm no longer going to get that super preferred rate. And there's a reason why I have so much term in force. is because once I
Yes.
won't get that rate anymore,
Convertible term.
convertible.
Convertible term.
Yeah, I got them laddered 10, 15, 20, 30-year term tranches. And I'm going to convert those from the shortest term going back. And I have a 30-year $1 million term to back me up. And that thing has all living benefits on it. Oh, baby.
Yep.
I got it covered me till 70 years old. I got that term with living benefits.
Right.
Like,
So that term, you have the guaranteed right to convert it to whole life at any point while it's still in force, no matter what happens to your health. And you can start advancing yourself that death benefit should you have some form of chronic or critical illness. That is a huge benefit.
and it's lien
So,
based. So it's not like some of those that brag about, and I'm going to pick on Transamerican, and I give them kudos, they at least offer it. But they have a discounted death benefit option on their term. So and we've talked about that before, but that's not the same as a lien based living benefit. Because with the lien based, if I take out 25 grand for a critical illness and I got $250,000 term, I know I'm going to have $225,000 of death benefit. It's just 25 minus 250. With that Transamerica term, I couldn't tell you how much you're going to get until you can tell me the day that you're actually going to have the claim. And then you might take 25 or 50,000 out of that policy. You might not even have any life insurance left, or not much. It might only be a little bit. It's not a lien base. And I'm not just picking on Transamerica. As a matter of fact, I have a contract with them. There's many others like that. I know they have living benefits on their term. Okay. But you got to know stuff. That's why you use insurance professionals. Guys like me and Logan here, we can let you know about this stuff. Most agents don't know about all these different things in and out. Sure as heck, the wealthy accountant doesn't know.
yeah, I was going to say, Peter, do you think he knows what the lien-based methodology is versus discounted cash flow methodology versus being underwritten at the time of claim versus being underwritten at the time you take out the policy? No, he doesn't know any of this stuff. He might just see, oh, $250,000 of death benefit equals $250,000 of death benefit in a completely different policy with a completely different company, a completely different structure, right? It's like, no, that's like saying this house is 2,500 square feet. That house is 2,500 square feet. Therefore, they're exactly the same. And if one costs more than the other, it's a ripoff.
Right.
So,
And that's, by the way, another thing I just want to, now we're rambling a little bit and I got to get going here, but ladies and gentlemen, if you're listening to this, please, I'll ask you this very important, 2 questions, really important. Question 1, when was the last time you did a life insurance review or life insurance policy review? Number 2, when was the last time you did a beneficiary review? Very, very important. Did you get married? Did you get divorced? Was there a death? Those things, trust me, there are people that are beneficiaries of policies all across this country that really shouldn't be right now. And the people just have never thought about doing a very basic beneficiary review. So reach out to Logan or reach out to me. We will gladly do that for you.
Yep. Okay. All right. Well, that was the end of this article. I think we covered it. And people have questions, they can come to Peter and me, but hopefully this has been educational. Thanks so much for your time, Peter. We look forward to the next one. In the meantime, God bless.
God bless. Godspeed.